Hello, everybody. The topic of this section is cash flow statement. In former section, we have explained two financial statements, balance sheet and income statement. In this section, we will explain the third one, cash flow statement, based on the former two. So, we will also use the hypothetical example of Generic Products Corporation GPC. The cash flow statement shows all of the cash that flowed into and out of the firm during a period of time. The cash flow statement is a useful supplement to the income statement for two reasons. First, it focuses attention on what is happening to the firm's cash position over time. Second, it avoids the judgments about revenue and expense recognition that go into the income statement. The income statement is based on accrual accounting methods, according to which not every revenue is an inflow of cash and not every expense is an outflow. This table presents the GPC cash flow statement for 2021. It organizes cash flows into three sections: operating activities, investing activities, and financing activities. For the cash flow from operating activities, the first content, net income, has been obtained in the income statement as $23.4 million. The depreciation charges were $30 million and are not cash expenses reduced from revenues in computing net income. Because the cash outlays for the plant and the equipment that give rise to the depreciation charges occurred when they were originally purchased, we have to add back the depreciation charges in the cash flow from operations. The increase in accounts receivable, $10 million, is the difference between the receivables of these 2 years in the balance sheet. This means the $10 million worth of goods and services were shipped and billed to customers in 2021 but were not collected. So we have to subtract the $10 million increase in accounts receivable to get from net income to cash flow from operations. The increase in inventories, $30 million, means the value of inventories at the end of the year was $30 million more than at the beginning. So, $30 million in cash was used to purchase or to produce goods that went into inventory, but was not accounted for in computing net income. Therefore, we have to subtract this increase in inventories to get from net income to cash flow from operations. The next, increase in accounts payable, $12 million, can be calculated from the balance sheet as the change between accounts payables of these 2 years. In computing net income, the full cost of goods sold was deducted, but actually, $12 million among the cost has not been paid. So, to go from net income to cash flow from operations, $12 million must be added back. Finally, the total cash flow from operations is equal to the net income plus the depreciation charges minus the decrease of accounts receivable minus increase in inventories and plus increase in accounts payable. The second section, cash flow from investing activities, shows the investment of GPC in plant and equipment for 2021. The value can be obtained by the difference of property, plant, and equipment in the balance sheet for the 2 years, 2020 and 2021. The third section, cash flow from financing activities, shows that the GPC paid out $10 million in cash dividends to shareholders and raised $94.6 million in cash by increasing its short-term debt. Note that the dividends paid value is consistent with the dividend allocation of net income in the income statement. The increase in short-term debt value can be obtained from the difference of short-term debts between 2020 and 2021 in balance sheet. The total cash flow is equal to the cash from operating activities plus cash from investing activities plus cash from financing activities. So, the total change in cash and marketable securities is equal to the total cash flow from operations, $25.4 million, plus the cash flow from investing activities, minus $90 million, plus the cash flow from financing activities. Dividends paid, minus $10 million, plus increase in short-term debt, $94.6 million, is $20 million. The construction of the cash flow statement has been completed based on the balance sheet and the income statement. Compare three financial statements. Some relationships among them can be found. For example, in the allocation of net income of the income statement for 2021, the change in retained earnings, $13.4 million, plus the retained earnings of 2020 in the balance sheet, $100 million, equals the retained earnings of 2021, $113.4 million. The final result of the cash flow statement for 2021, total change in cash and marketable securities, $20 million, is the same with the change cash and marketable securities from 2020 to 2021. These relationships can help us to check whether the financial statements are constructed correctly. As we have explained, there are many contents in each financial statement. It is important to do the calculation accurately. The mistake of one value might make the construction of all statements more complex. Therefore, we should be serious and precise when constructing financial statements. In addition, the financial statements imply much useful information of a firm, and its management should obey the law and cannot make financial fraud. For instance, Luckin Coffee is the largest chain coffee brand in China. It landed on Nasdaq on May 17, 2019. During 2019, the total cash flow from operations was negative every quarter. This suggests that the operating activities demanded a lot of cash flow. The cash flow from investing activities was also negative every quarter and suggests that the investing activities were not going well with inadequately funded. The positive cash flow from financing activities can alleviate the problem of insufficient funds but increase the repayment pressure at the same time. In the net income statement of the second and third quarters of 2019, the operation incomes increased highly based on the increase in unit price and the increase in the sales volume. This violates the law of reverse fluctuation of elastic commodity prices and demand. On April 5, 2020, Luckin Coffee Company admitted that millions of dollars in sales had been fabricated. 2 months later, its stock was delisted on the Nasdaq exchange. In December, the Securities and Exchange Commission slapped the company with a $180 million penalty to settle fraud charges. This company not only broke laws and regulations but also damaged the Chinese corporate image. Therefore, it's important to obey the laws and be serious to the financial statements. In summary, in this section, we have explained the construction of the cash flow statement based on other two financial statements, balance sheet and income statement. We also emphasized on the infeasibility of financial fraud. That's all about this section. Bye.